markets trading up. They've breached that 4,000 resistance level. Seems to be the story of the last few sessions. Can this momentum be sustained forward into the second quarter?
Well, thank you for having me in the show. I think for the last 3 days on the market, we've seen the market really come up. But looking keenly into the data, we've seen that there's been a lot of speculative tendencies in the market, particularly on some of the banking stocks and the traditional speculative counters. So, in my opinion, I'm thinking that once these speculators are really out of those particular counters, then we will see the index recede back to the 3,900 level, because the real fundamentals as to why investors are avoiding the market have not really been ironed out, in my opinion.
All right, we do have a report out as to how the markets performed in the month of March compared to what it was in February. And we have seen some declines in market activity leading to a drop of 8.3%. What's going to spur on this recovery? We've had very good results. We've had good dividends being paid out. Yes, there's a fear of inflation. Yes, there's a fear of political uncertainty. But generally, equities have done well.
Yes, I reckon with that, because if you look at most of the companies listed from a fundamental point of view, I mean, there's no reason why we shouldn't see some counters trading above even 52-week highs. But in my opinion, I think that most of these gains were factored in around December, where most investors were expecting banks to do well. Well, comparing the month-on-month activity, well, it was down 8%, primarily because we saw the bulk of the retail investor really avoiding the market. But going forward, I think the theme will be more of, from a fund management point of view, that they'll be restructuring their portfolios for us to see how, I mean, for them to see how they're going to better report good returns. So, in my opinion, I think the coming quarter will be quite instrumental to some degree to see how the market will recover.
I mean, obviously, we've seen equity turnover up by about 28%, thin volumes granted, but there are the favored counters, blue chips like KCB, Equity Bank, Safaricom, foreigners flooding into those particular stocks. What's it going to take for other companies to be competitively more attractive?
Well, I think that if you look at why foreigners tend to favor some of these companies, is because the underlying bottom line is quite favorable for them. And I think once, in my opinion, the price levels have reached a point whereby they feel they're paying a premium for it, then you'll automatically see more investors going into the other counters, the likes of, say, I mean, you're looking at the likes of scan groups, I mean, the likes of more of income stocks and value stocks. But for now, so long as there's that foreign component in the traditional counters, be it Safaricom, be it, I mean, KCB, and also equity, then those will be the three counters, I mean, each and every investor will be watching. I
mean, obviously, investors consider a variety of other things, the book value of companies, price to earnings ratios, and we know that PEs are currently at about 11.6%. So what's going to be value for money for investors coming into your market?
Well, I mean, value for money is that, well, investors will be looking at where the market was, say pre the, I mean, from where we left at just before the financial crisis, and people will be targeting that as a possible ceiling for them. So from looking at where the market was and to now, we are looking at returns of almost 50 to even 40% return, I mean, on some specific counters. So long as there's this value proposition in most of these counters, then investors will tend to come in. And then also to introduce another dimension is that if you look at whatever is happening in the bonds market, investors don't really see a value proposition from that perspective. So for them, the equities offers that quick back, as you may call it.
I mean, obviously, you've raised the bond markets. This leads me to questions around what's happening on the fixed income side. Turnover reduced by 18% between March and February. Yield somewhere in the region of 5.6%, 4.7%, depending on whether you're on the long side or the longer end of the shorter end of the curve. Just explain to us what it is that investors are feeling about government securities.
Well, it has been quite an interesting story all along, particularly for the first quarter, because I'm looking at, we are expecting a primary next week on Tuesday, and the sentiments in the market are that the yield curve is quite distorted, particularly around the 10 and 15-year level. Now, with the reopening of the 15-year paper in the bonds market, we are seeing that most people are looking at yields of around 11.5 to even 12% being aggressive. Now, if this does materialize, then it tells you that the yields have been consistently coming up. Again, looking at I mean, macroeconomic data from inflation point of view and interest rate point of view, I mean, the 182 days at 3.2% now. I mean, all these factors are playing in any position that you might look at in the yield curve. Right. So in my opinion, I think we should just brace ourselves for higher yields in this particular quarter.
What does that mean, Henry, for corporate bond issuances? Because we are expecting to see at least 4 corporate bonds being launched this year.
Sure. Well, what it means is then that most investors, I mean, would be asking for higher premium because, I mean, they'll be looking at, if you're looking at issuing a 10-year bond, then if a corporate is doing a 10-year bond, then they would have to issue, I mean, a modest premium above what a similar 10-year bond is trading at. So all this, then it will mean that it will become a bit quite expensive for corporates to, I mean, to raise capital through the fixed income market because of the premium yield, I mean, premium coupon most investors will be asking for.